Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to today's episode on Christmas Eve. If you're listening on Christmas Eve, I hope you have a wonderful Christmas if you celebrate it. Anyway, over the next 4 weeks, I want to share with you a 4-part series which I have called Wealth First Principles. These are the ideas that really sit underneath any wealth strategy, whether you're just beginning or if you've been investing for decades. Because the reality is that most investors drift over time. They get distracted by noise, new products, market commentary, search for a kind of a clever shortcut. But really, wealth isn't built on complexity. It's really built on a small number of principles that do not change, which is, I guess, at the core of the book Investopoly, which obviously the podcast grew out of that. And of course, investors that stayed anchored to those small number of principles tend to produce consistently better results over time. So if you're an experienced investor, I think this series is an opportunity for potentially for you to recalibrate, kind of remind yourself of these sort of fundamentals that drive great outcomes. But of course, if you're new to investing, it's a chance to start with some clarity and potentially avoid those unnecessary mistakes. And also, over the holiday period, we tend to talk to family and friends about money and finance and investing. So if you know someone that would benefit from listening to this podcast, this series might be an excellent place for them to start. A bit of a good introduction. My aim over the next 4 weeks with this series is really quite simple. I just want to strip away the noise, refocus on what truly works, and help you build a framework that stands up in any environment. Okay, so let's start with part 1 in the 4-part series. And I've called this Understand How Wealth is Actually Built, because I think it's really, really important to understand how the most successful investors build wealth over time. The issue is that there's so much noise out there. The financial media and social media are full of success stories. Someone that bought crypto at the right time, a quick property development. There was one in the Australian Financial Review a few weeks ago about how someone in their early 20s has got 6 investment properties and $2.8 million of debt or something like that. A person who picked the bottom of the market, a person who picked the stock that, gave 1,000% return. The thing is, these stories aren't representative, they're statistical outliers, and the problem is if we start getting influenced by all this, it's difficult to kind of cut through. The benefit I have as, someone that's been doing this for almost 25 years is I get to sort of see through all that and get to identify and experience the investors that have actually built substantial wealth over time. And so it's easier for me to, I guess, get an appreciation for that. Whereas I think most people, they know about their own financial situation and maybe some family and friends, but their data set's very small, whereas I've got a much larger data set. But that's the whole point of this podcast, is I like to share this information to hopefully you can benefit from as well. And the reality is, just like everything in life, extraordinary outcomes are produced really just by doing the small things consistently with discipline over a very long period of time. And that's why sometimes you see a lot of high income earners and they don't have a lot to show for it, or at least the asset base doesn't reflect their high income, because they've been distracted over time, chasing returns, changing direction, too busy, working to make actual decisions. It doesn't translate into wealth. What translates into wealth is firstly having a robust strategy and methodology, investment methodology, which I'm going to talk about today and also over the next 3 weeks, but also then just having a sustainable way to continually, make investment decisions and repeat those investment decisions and automate them as much as possible. I'll be talking about that over the next few weeks as well, so that you're taking, that's saying, a journey of 1,000 miles begins with one step. It's exactly right. That you just got to start and you got to take that one step and then the next step and then the next step. And you keep doing that consistently. In a few years' time, you won't be better off. You'll just think, oh, this isn't really working. But in 10 years' time, you'll be miles better off. And that's the thing with wealth. And so what I'd like to propose to you is a really simple formula for you to understand how wealth is successfully accumulated. And the formula is as such: wealth equals cash flow surplus multiplied by by investment efficiency multiplied by time. And I would say that this works with every investment strategy, every structure, every asset class, ultimately feeds into these inputs. And I'm going to talk about each of these components, but if you can just think or conceptualize that formula and understand the formula and then focus on the formula and then come back to every decision to make sure it's in line with this formula, it's probably one of the most powerful kind of lessons you can learn when building wealth. Okay, let's talk about cash flow surplus. So, I mean, that's the first component in the equation, arguably the most important. When we talk about surplus investable cash flow, that's the amount of income that you can consistently allocate towards investments. It's the fuel really for your investment strategy. And without surplus cash flow, nothing can compound. Of course, if you've got nothing to invest, it's difficult to, produce assets out of thin air, of course. So that's why the first decade of a person's working life is often the most important, because even though income is typically quite low, the reality is that living costs are also low and lifestyle expectations are pretty modest as well. And so therefore, it's a perfect environment to establish a meaningful savings habit and get them into the habit of saving and investing surplus cash flow. And it's a habit then they can take through the rest of their working life. And if they do that, they're, off to certainly a great start. Conversely, if you allow kind of lifestyle inflation, quite often it'll eat away at the cash flow surplus. That is, when your income increases, your standard of living increases and cost of living increases in line with that income. The higher income doesn't necessarily then translate to a higher surplus investable cash flow. And in that situation, doesn't matter how hard you work or how much income you earn, if it doesn't translate into more investable surplus cash flow, again, there's not enough to compound and you're not going to successfully build wealth. So finding that surplus cash flow and having the discipline to allocate it towards your investment strategy every week, fortnight, or month is certainly the key to building wealth. And as I said, the first part of the equation. And part 4 in this series, I'm going to share with you a cash flow and debt management insight. That's on the 14th of January 26, so next year. But I think it's probably the best one in this 4-part series. I don't know. I mean, it'll resonate differently with different people, but I'm really proud of that episode, the content in that episode. So if you're having issues with surplus cash flow, that's the one to certainly watch out for. Okay, the next element in the equation is investment efficiency. And really the best way to explain that is the best bang for your buck. If you've got this surplus cash flow, how do you turn that surplus cash flow into the biggest pool of assets in 10, 20 years' time? And so the efficiency is sort of driven by a number of different factors. So firstly, asset selection. We can't control market returns, but what we can control is where we invest our money. So which asset classes, whether it's investment grade property or fundamentally sound ETFs, those sorts of things. The second element to efficiency is cost control. So fees compound just as reliability as returns do. So again, if it's investing in the share market, we want to use a low cost approach to doing that. Something I speak about a lot, and I will revisit that in the 3rd episode of this series, which is on the 7th of January. If it's investing in property, then cost control is really about reducing the negative cash flow of the property. So firstly, as I've spoken about this year, I did an episode where I talked about, when you go and buy a property, firstly focus on the growth, which is really only the capital growth of that asset, which is by the highest quality land, essentially. And then once you've got that asset, forget about growth because that's all locked in now. It's really then about minimizing cash flow. So maximize your rental yield, can do that through potentially improving the property or better property management, and then minimize your outgoing as much as possible. Interest is obviously the key one there. The third element towards investment efficiency is being tax aware. So, making sure you think about taxes and try to reduce the tax drag as much as possible. And the last part to investment efficiency is avoiding large behavioral errors. So don't let emotion influence decision. Don't unnecessarily interrupt the process of compounding. Don't switch investments all the time just because you start to become uncomfortable, unless you conclude that the original decision was incorrect, fundamentally unsound. Of course, then you can switch, but don't just do it because you've hit some volatility which was always expected or should have been expected from the outset. And what matters here with investment efficiency is not the highest possible return in any one year, but really the highest return on average over a very long period of time. This means really following investment grade fundamentals and avoid, things like speculation and so forth. And the last element is time. And time is a critically important one because it essentially magnifies the first two parts of the equation, which is cash flow and investment efficiency. And over very short periods of time, those two first components don't necessarily produce a lot of wealth, but over very long periods of time, that's where you enjoy the compounding. And mathematically, that's where you're going to get all your returns. And I guess there's two sort of critical things to consider when thinking about time. Firstly, it's non-linear. So a few weeks ago, I talked about, how a property can compound over a 30-year period, and that if you bought a $1 million property today and you got a 7.2% compounding annual growth rate on average over that 30-year period, the property would double in value 3 times, so it would be worth $8 million. So over that 30-year period, you accumulated $7 million of equity, because obviously it cost you $1 million to begin with. And how that equity compounded and delivered itself was not linear. So of that $7 million, 15% occurred in the first 10 years, whereas 60% occurred in the last 10 years. And so that's a really important thing to understand, particularly for new investors, right? Because if you're just starting out, you've made some fantastic decisions, you've nailed every one of them. And in 5 years' time, you think, look, I've worked so hard, saved so hard, made some great decisions, but I'm better off, but not miles better off. That's okay. Just let time do its thing. The other thing, I was going to mention 2 points. The second of those points is that time, once it's gone, you can never get it back. And that's why procrastination is the most expensive cost or mistake that you can make when investing, because time is a critical component in this calculation, in this equation. And the longer the time component you can contribute towards your wealth equation, the less risk you need to take as well. So I think once you understand how important time is, you won't worry about trying to pick the right moment. It's just about getting started and taking those regular discipline steps to invest your surplus cash flow every fortnight, week, month, year, whatever it might be. And you stop worrying about sort of market movements and start worrying about your own savings rate. And efficiency and investment efficiency, knowing that time, if you get those two things right, time will do all the heavy lifting in terms of building your wealth. And this is why speculation, and quite often some investors tell themselves they're investing, but really they're speculating. And I think we need to be really careful about that to really define, what are we doing? Is this pure investing? Will this compound over time? Or is this just really, am I driven to this investment opportunity because I think I'm going to make a quick gain? And we have to continually ask ourselves to do this, whether we're choosing an ETF, whether we're choosing a location to buy an investment property, or whatever we're looking at as an investment. Speculation fails because it's mathematically flawed, of course. Now, if I go and buy a property that I just referred to, 7.2% compounding over 30 years, I don't need to be, smarter other than buying that property. I don't need any special insight. I don't need market timing. All I need is to have enough surplus income to be able to continue to hold that asset, invest well, and remain invested. That's all I need to do. But if I'm speculating, I need to think about when to buy, when to sell, and I need to get those two decisions perfectly right. When to re-enter the market, I've got to find the next best investment opportunity, and I need to do that consistently well. So I can't afford to make a loss. I need to keep rolling that profit into the next opportunity. And it defeats the purpose. You're going to have a lot of tax drag. You're going to have a higher risk of, making a mistake regarding timing. And that's why consistent compounding always beats sporadically high returns. So even if you can achieve those high returns, that's great, but can you achieve them year after year after year, or investment after investment after investment? And we see it in the results too, right? In terms of the share market results, when you look at active fund managers, professional managers, these people that might be spending literally 80 hours a week studying the share market, they just can't do it consistently well. 80% fail to beat the index generally, and whilst a third of them can do it, can beat the index 2 years in a row of that 20% that did. Very few can do it 3 or 4 years in a row. They are certainly unicorns. So I'm not saying it can't happen. It does happen. There's a tiny, tiny, tiny number of fund managers that do that, but it's a very low probability strategy, whereas compounding is a very high probability strategy. So that's the equation. I think it's worth reiterating it. Cash flow surplus times investment efficiency times time. They're the components you need to obsess about. Avoid speculation, avoid being enticed into these sort of short-term investment opportunities. Next thing I want to talk about in terms of how wealth is actually built is leverage. So there's borrowing to invest. And what that can do is sort of multiply the impacts of this wealth building equation. And property tends to be the most sensible asset to use to add leverage into a portfolio. And the reason for that is that prices tend to be relatively stable. So property has half the rate of volatility than shares do. Banks are willing to provide funding to buy property at more attractive interest rates without margin calls and so forth, and with negative gearing benefits in terms of being able to offset those losses against other income. Essentially the federal government's paying for half of the holding costs through negative gearing tax benefits. And if you're buying investment grade property, it's high quality property, and you hold it long enough, as that example that I keep referencing, it shows you that you can build an extraordinary amount of wealth over a long period of time. Now, leverage only works when you've got 4 characteristics: that the property is fundamentally sound. So you can't just acquire any old property. And this is the problem with leverage, is that it can mask mistakes. Because leverage increases the return, people think, I invest in this property and I generated a 6% return with my leverage. That's pretty good. Well, it's not really, because it would have been much better if you had a fundamentally sound property. So it can hide mistakes, leverage. You just got to be careful with that. Second thing is you've got to have the cash flow. So it's got to be affordable, got to be in a position where you're going to be able to afford the highs and lows of holding on to property. There's going to be years where there's a lot of maintenance, other years where there's none. But you just need to ride through that period. Particularly the hardest period is the first 10 years, typically. Investors need to maintain adequate buffers in place as well. So again, if that you have a large expense, a large maintenance expense, that can cause a few problems if you don't have those buffers in place. And lastly, as I keep talking about, you need a long time horizon. And so without one of these 4 things, leveraging starts to become a risky strategy. But if you can tick all those 4 boxes, leveraging, particularly if you have that long time horizon, if you are in your 20s, 30s or in 40s, it's going to sort of multiply the impact of that wealth equation. Now, talking about shares, I've made this point before in the podcast that it's not a property versus shares question. It should be a leverage versus unleveraged question, because if you should add leverage to your investment strategy, then you probably should use property to do that. But if leverage isn't appropriate, then maybe shares is the best approach. That approach to that question isn't always the same. There's nuance, of course, like in every sort of situation with financial planning. But I think it's a better way to kind of reframe the question as a property versus shares, because I think investors should be investing in both. It's really a timing question. So given your stage of life, should you be adding more gearing or should you not? Or should you be adding more liquidity? But shares compound too, and particularly, if you've got to think about the income capital split, international shares tend to have a very low dividend yield, less than 2%, so most of your return's going to come in the form of capital growth, whereas with Australian indexes, they're typically 50-50, you're going to have 50% income, 50% growth. Now, if you're reinvesting that income and you can do that tax effectively, that's a great outcome because your total returns are compounding, but it's something to really think about. And as I mentioned last week, I think it was, Campbell's going to prepare a podcast episode around should we have so much invested in the Australian share market. When you look at diversified ETFs or high growth strategies in your superannuation, they tend to have pretty large allocation to the Australian market. We're going to revisit to, pull that apart to see if that's really the right way to go. Now, with gearing with shares, it still is appropriate. I think you've got to be really careful because shares have twice the amount of volatility than property does. So if you're going to gear heavily into shares, you probably want to use a mortgage secured by equity and property rather than a margin loan if you're going to be that sort of aggressive. But I think entry point, because of the volatility, entry point matters matters more than what it does with property. I still think being conscious of property cycles is critical, and you don't want to buy at the end of the growth cycle, at the peak of the market. That's not ideal either, but that can be more challenging, I think, when gearing heavily into shares. So I think gearing can be a great strategy into shares, but I think the entry point has to be considered. I just think in generally shares benefit, or share strategies benefit from lower gearing, rather than such high gearing that you would use with property. And I wouldn't really think about the gearing rate in isolation. I would think about your gearing rate as at a total portfolio level. So that is, I've got some invest in property, some invest in shares. What is my overall gearing rate? And just be comfortable with that rather than necessarily trying to maximize gearing every single asset class. It doesn't always work as well with that from that perspective. Now, this episode today is all about understanding what's building wealth. Let's talk about behavioral, because human behavior is probably the biggest risk when building wealth. Actually, not probably. It is really. I mean, if I think about all the mistakes that people have made, I've seen investors make, they're all behavioral mistakes. So reacting emotionally to short-term volatility, chasing last year's returns, failing to remain consistent, so sort of sporadic investment strategy in terms of surplus cash flow, attempting to time the market perfectly. I think sometimes it's important to time the market. You need to be conscious of property cycles, for instance. If you're going to use a huge amount of gearing into shares, you need to be conscious of timing there. But also, if you're just thinking, well, I don't want to invest in the stock market today because it's all-time highs, that might be true in certain indexes, but it's not true in all indexes or all strategies. So there's always good opportunities in markets. Sometimes there's better or a greater array of better opportunities, but there's always decent investment opportunities in most times in markets. Interrupting a strategy, so just abandoning the strategy just because it hasn't worked. An example here would be, anyone that bought an investment grade apartment in Melbourne over the last 13 years. If they decide to turn around and sell that property, I think in 10 years' time, I will be recording an episode to say that was a mistake. So, we know returns are not straight line, and we certainly hope that we don't have a 13-year flat market like has been the case for apartments in Melbourne. But the longer the flat market, the more aggressive the rebound will be. And lastly, procrastination, probably the most important or most costly of all behavioral mistakes. And so I think to counteract these behavioral mistakes, using a rules-based long-term approach is, I think, the best antidote. Because if we're really focused on long-term outcomes, we can then drown out this short-term noise. And if we're using rules-based approaches, I think it gives an evidence-based approaches, it gives us a greater confidence that it's going to work, because we can say, look at all the data. If we had have done this over the last 30 years, this is the result would have been, would have produced a great result. So I've got greater confidence. I'm not throwing darts at a dartboard. I'm using a rules-based, evidence-based approach. And I think it also then helps people to sort of stick to that approach, knowing that it does have the evidence, that they're not just putting their faith in, what someone believes or said or predicts. It is really based on the evidence. So then if I wrap this up into, how wealth is actually built, you can probably summarize it like this. Protect and grow your surplus cash flow. So it starts there with surplus cash flow. You've got to have the discipline to find that surplus cash flow every week, fortnight, or month. Invest regularly, regardless of market noise. So don't turn it on or off. Consistency is the key here. Use simple, rules-based, evidence-based, low-cost, diversified tactics. Everything I'm going to talk about in the next 2 episodes. I'm going to do one on property, one on shares. So I'm going to, share that exact approach there. Use leverage where appropriate. Maintain buffers to avoid selling. So don't fly too close to the sun. Be careful. Don't be too aggressive. Building wealth is a marathon, not a race. If you can do it over 20 years, chances are you don't really need to take too much risk. In fact, I would say you can have a very low risk strategy that's going to work really well, and allow time to do the heavy lifting. So begin as soon as you can, keep investing as long as you can. And if you've got a long runway, you really don't need to take too much risk. And if you implement this approach, you're going to outperform the vast majority. I think you'll be in the top 10% in terms of investors and outcomes. So the whole basis of today's episode was really trying to impart on you that building wealth is not based on amazing predictions or exceptional foresight or secret strategies or anything like that. It's really just a product of consistent, smart, simple, evidence-based, rooted in basic logic and mathematics decisions time after time. It's very simple. You don't have to overcomplicate it, but you do have to understand it. Now, whilst it's simple, it's not always easy because there's so much noise around, it's easy to get distracted. It's easy to lose faith. It's easy to let sort of the emotion of greed take over and think, there's a better opportunity. Or you hear a story from a friend or colleague of how well they've done out of a particular transaction. You think they're doing better than me. I should be doing more or taking more risk. There's always going to be these distractions out there. So that's why it's not easy, but it's certainly simple to understand. And if you really anchor yourself to this framework and run every financial decision through it, in the long run, you will be the winner compared to the people that are using more of a speculative approach. They might have an exciting ride and they might have some big wins, but at the end of the day, it's really about choosing this investment strategy that's going to get to your goals with the lowest amount of risk. And when I say lowest amount of risk, you can turn that on your head and say it has the highest probability of working, and this approach has the highest probability of working. Okay, let's get into some Q&A. I've got one. I'm not going to, just to preserve, actually, it probably doesn't matter. This is from Josh. I just won't talk about addresses or anything like that, just to preserve privacy. I've got a really long email here, so I'm going to have to sort of summarize it. But essentially, well, firstly, Josh gives me some great feedback on the podcast, so thanks so much. But essentially, Josh lives just outside of Adelaide by the coast, has a investment property in Adelaide, which, as I understand it, isn't an ideal asset. They have a child they'd like to move back into Adelaide in 10 or so years' time. School, university, job opportunities for their child. That's the reason for moving back. And so the strategy that Josh has shared is that sell the investment property, go and buy sort of something sort of family home style, but investment grade asset in Adelaide, live by the coast, and then eventually move into the one in the city. And he's asked a bunch of questions around, should they keep the coastal property in the long run, view on sort of borrowing capacity and appetite, and then just a few questions around Adelaide as well in terms of timing. It's an interesting, really interesting question, I think, or insight. So I guess the first thing, and I like to answer Josh's question, but also make sure that I'm sharing information that's useful to everyone that's listening. So I think the broad strategy of trying to buy an asset where you eventually want to be and particularly live is typically or almost always a good idea. That's just because, as I mentioned a number of times before, that if the cost of that asset is going to be much higher in 10 years compared to today, and it's going to be my home, then I've got to pay from after-tax dollars, which either means I need to put a lot of cash flow towards it, so work really hard, save really hard to repay the loan, or I need to sell assets. So either way, it's an expensive exercise. So that's why buying it now and minimizing that future cost or avoiding that higher future cost is a better way to go. So that is true. I think with respect to, appetite levels and gearing levels, what Josh is kind of asking is the strategy involves a high level of gearing and how to sort of navigate that. Well, in the new year, I'm going to record an episode about bank and non-bank lenders because it's the market's really changed over the last 20 years. Actually, really, if I reflect on it, the market is probably like it was in the 90s in terms of non-bank versus bank. And so it's kind of gone full circle, I guess. But anyway, it's something that we all need to be conscious of because we've got to play that lending game and try and use the lenders to our advantage to be able to execute on our strategy. But the thing with higher gearing is I think what we need to do is firstly make sure you think about all the risks. What happens if you lose your job? What happens if you can't work for 6 months? What happens if you have a car accident? Some of these answers are get income protection insurance, have buffers in place in terms of cash in offset account or ability to redraw, these sorts of things. They're probably the answers. Then the second thing would be is just make friends with the adverse outcome. So, whenever I've pushed the envelope in terms of borrowing capacity, I've said, well, we'll try it, we'll do it. Look, if it doesn't work, in 2 years' time, we'll sell the asset and we'll exit the position. And, if we're buying well and we're not overpaying, we're buying a good quality asset, chances are we can walk away with hopefully no loss, net of cash flow costs, all that sort of stuff. But, maybe if you're going to make a loss, it's going to be tiny and it's not going to be the end of the world. And so instead of making a commitment, a 10-year commitment, for the next 10 years, I'm going to have this sort of really tight cash flow position. I've broken it up and said, look, let's see how it goes for 2 years. And if it's going to stress me out, I'm not going to do it anymore. And as I said, if I can walk away and not lose money, I'm no worse off. That's kind of the approach I've always taken. And the reality is in 2 years' time, you actually think, oh, this is a lot more comfortable than I thought it would be. Things change, things improve, and it all works out fine. So that's the way that I've always approached it, Josh. And so if you think you've got a good strategy there, and Josh has made the comment that I think it's affordable, then really it's about finding an awesome broker that's going to know the rules of the game and play them to your advantage. And I'm not suggesting here that you do anything wrong or lie or manipulate applications or anything like that. It is really working within the rules, but it's someone that really has a good understanding that's going to help you do that. And then in terms of, you need to have a broad strategy to say, like, I'm going to buy this asset, I'm going to live here, then I'm going to sell this asset, I'm going to buy this other asset. You need to have a broad strategy, right? But, when you're contemplating decisions that you might make in 5 or 10 years' time, I wouldn't be too rigid about them. You need to let time do its thing. So, because Josh has asked me about, maybe I should keep the beach sort of property when we move back into Adelaide. I was saying, well, you don't really need to. That of course you could, and you can use that as a way of reducing debt, but it's not a decision you necessarily need to make today. And the last sort of comment was really around implementing this strategy in Adelaide, knowing that Adelaide has produced the best capital growth over the last 10 years out of the 5 capital cities, which is a concern. And if I'm going to share a mistake, if I think back 10 years ago or even sort of 13 years ago, so I'm talking 2010s, 2012, 2013, sort of around that time when clients were buying apartments, investment grade apartments in Melbourne, which are fundamentally sound assets. But if I had have looked at, and be more conscious of growth cycles at that time, it probably would have been obvious to me that that was a mistake, that, we should have expected a flat cycle, because I think looking at apartment growth between 1980 and 2010, off the top of my head, it was like 8.5% in apartments. That's too high, right? So it should have been obvious to me that the market was overcooked and, that was a risky proposition. I don't think it's the same extent. I think Adelaide's like 7.5% growth. I did a blog on it earlier this year. So I think it's around about that mark. And it has slowed a little bit. So it's sort of showing that maybe, it's getting to an end of a growth cycle. That would be my only reservation. So as a general rule, go and buy the property that you want to live in 10 years' time now. But in this circumstance where we're buying a potentially overcooked market, you could end up buying that asset and actually not generating much in the way of growth over that period of time, but you will lose income because obviously the negative cash flow. So you might actually be worse off. Really difficult decision, Josh. And I don't really know, I haven't done the full plan for you and really consider it, but I would have a substantial concern about whether I would want to implement that strategy for you. So I can't give you the advice because, of course, nothing in this podcast is advice, but I can't definitively tell you if I was in your shoes what I would do, but I think I'd be leaning towards perhaps not doing that in terms of buying that forever home closer to Adelaide. I don't know if I've actually been helpful, Josh, in answering your question. I guess I've shared some thoughts on a couple of things, but all the best anyway. And for those that celebrate Christmas, I hope you have a fantastic Christmas day tomorrow. Get some time to spend with family and friends. And next week, we're going to talk about first principles associated with investing in property and sort of going through that process. How do we begin? And that'll be on New Year's Eve. So there you go. So great way to kick off the new year. Okay, until then, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.